In this video, we're going to talk about Lucid Motors, trading under the ticker symbol LCID. Before the video begins, just a quick heads up that not all my content is made on the same day they're posted. If there are material events that happen afterwards, I will then make a follow-up video to reflect those changes. With that being said, let's go on to today's topic. Lucid Motors is a startup based in Newark, California. It manufactures electric vehicles and specifically targets the high-end segment of that market. The main appeal of Lucid is that it is based in the US and is widely considered as a potential rival and alternative to Tesla. This means that the market participants who want to either hedge their exposure in Tesla and those who believe in the sector of electric vehicles may consider investing in Lucid. Another appeal for the investors is that unlike other EV startups like NIO, Lucid is based and operates within the United States, so there will be little to no worry about the effect of remote oversight and geopolitical aspects. The recent catalysts have been focusing on the release of Lucid Air, but Lucid, like the rest of the sector, is also confronting the issue of supply chain. From a corporate and equity perspective, Lucid Motors is a company that benefited from the risk appetite across the board. The fact that Lucid arrived in the golden age of EV startups and SPACs, in a sequence of events when the demand for EV stocks was peaking and going through the roof, also completed the bucket list of things required for Lucid to reach historical peaks way back in late 2020. Keep in mind that the popularity of Lucid shares is mostly thanks to the fact that between 2020 and 2022, the stock price of Tesla was multiplied by 10 times. And because people believe that Lucid is a valid alternative to Tesla, but at a more affordable price and at a more earlier phase. In that sense, what is good for one is often good for the other, and vice versa. Recently, Tesla published its financial results. Despite excellent fundamental results, they're also expressing worries about supply chain issues, and this has sent the shareholders in the sell-off mode. Personally, I think that the market is a bit overreacting at the moment, and it is doubled down by the simultaneous sell-off of growth stocks in general. Lucid and Tesla are a bit apart from the whole startup scene since they have a longer backstory, but it doesn't stop their stocks from getting sold along other EV stocks, and I would say the growth stocks in general. The reality is that this market-wide movement of growth stocks being sold off and the sector-wide supply issues are nothing new, and they are simply being resumed after some recovery in late 2021. We also know that it's not going to last forever, even though the same can be said about any takeoffs or any crashes, which I mentioned in one of my earlier videos after Lucid Air was announced to be rolled out. Let's also take a look at the technicals of Lucid Motors. The trading volume of Lucid has recently been 35.3 million shares, compared to an average volume of 46.5 million shares. Over the previous 52-week period, its price has fluctuated between $16.12 and $64.86. The market cap of Lucid Motors is currently at $45.6 billion, compared to an enterprise value of $26.3 billion. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company, based on its current fundamentals, leverage, and asset composition. Some of the examples of the impact by leverage is if the company has a lot of debt, then the market may feel uncertain about the company's capacity to pay back its interest and principals, which in turn may negatively impact the profitability, attractiveness, and even its solvency. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is called goodwill. Goodwill is basically an expectation of the market that the company is able to generate more profit or to have more growth than other companies, partially because it has a good management, stronger brand recognition, bigger online following, or other elements as such. It is basically what is unique about this company in particular compared to another one of the same sector. In other words, it may not be a tangible asset that companies can use, but it's often the reason why some companies are perceived by the market to be trading at a discount, because the market cap is lower than the enterprise value, which is the value the market gives to the company's assets, including the goodwill, when the debts are paid off. In case the company goes to liquidation, goodwill would be completely impaired, and we would be left with potentially less assets to distribute to shareholders and debt holders than the figures shown on balance sheet. In comparison to its historical price fluctuations, the stock is 8% higher than its 1-month low, 8% higher than the 3-month low, and 71.7% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment on where the stock price is likely going to head toward, the implied volatility is 106.9% compared to a historical volatility of 89.7%. The put-call volume ratio is currently at 1.05. It is normal for most stocks to also tend to have a higher put option volume than what they really deserve, because many institutional investors choose to hedge their exposure by buying put options. The most recent volume of options traded has been 122,000 contracts within a day, compared to the 30-day average volume of 275,000. Regarding the open interest, the most recent volume of open interest has been 1.04 million contracts, compared to the 30-day average of 1.2 million contracts. In terms of its shareholder structure, institutional shareholders own about 69.2% of all outstanding shares. The biggest shareholders include Vanguard, Franklin, and Blackstone. Understanding shareholder structure is relevant to an extent because it helps to determine whether you should be holding the stock long-term or to view it as a short-term volatility trade. If the stock is mainly held by retail traders, then it may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Usually the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment, and not just as a short-term trade. This is obviously subject to a lot of exceptions, since many titles are mostly held by retail investors and not institutional investors. But that tends to be the exceptions and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit should the share price fall lower. Sometimes there may be significant short interest in a stock, and that can be a sign that there is an organized shorting operation going on, like what has been going on with GameStop and AMC. The current short interest is 15.6% of the total float and 60.2% of all dark pool transactions. Now, let's also take a look at the indicators. Financial indicators give us a suggestion of what the price movements are showing, and they can be used as one of the elements to determine what should be our overall approach. Oscillators are showing 2 sell, 9 neutral, and 0 buy, with an overall tendency of sell. The moving averages of the past price actions show 13 sell, 1 neutral, and 1 buy, with an overall tendency from the perspective of moving averages to strongly sell. Keep in mind that indicators often show what the present and the past performances have been, but rarely predict accurately the future. Nevertheless, they are relevant to determine if the timing of the trade is the right one. In terms of pivot points, which are levels of support and resistance sprinkled in the price trends, the support levels are $12.35, $20.63, and $25.82. For the resistance levels, they are $31.40, $55.53, and $56.16. My recommendation is to keep Lucid on your watch list and to make sure that the exposure doesn't tip over the balance of the entire portfolio. The sell-off is slowing down, but I don't think that it's over yet. The only way we know for sure that a storm is behind us is if the bottom is already surpassed in a substantial way. And that is more than fine for me personally, not to scoop the bottom, as long as the cost basis is reasonably low if the trend reversal has been confirmed. I would suggest to keep a maximum exposure of 3 to 5% of Lucid stock in your portfolio, and do not enter the trade just yet. Wait for a few days or even weeks, and see whether the market has found some support lines before committing more capital. The profit target is the previous peaks for the short term. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks being shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants, in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.